Okay, let's just jump right into this. You know that universal, almost physical shock of seeing your very first paycheck? Your offer letter said one thing, everyone in HR smiled and agreed, you literally planned your entire monthly budget around that specific number, and then the actual payday arrives. You open up your banking app, super excited, only to realize something doesn't quite add up here.
Right? You were promised one number, but a noticeably smaller amount actually lands in your account. You're left staring at your screen just thinking, wait, where did it go? And then you check your payslip, and right there, hiding in plain sight, is this silent deduction that just snatched a piece of your hard-earned money before you ever even got to touch it. Well, in this explainer, we are going to completely solve the mystery of that missing salary. We'll figure out what TDS exactly is, track how the money flows, break down the rates on your payslip, check your Form 26AS report card, and, most importantly, talk about claiming your refund.
So, Part 1. The missing salary and that silent deduction on your payslip.
That mysterious deduction is called TDS, which simply stands for Tax Deducted at Source. And honestly, the name gives the whole game away. It's literally tax collected at the exact point where the income is generated. So think of it like this. The government essentially deputizes your employer or your bank or your clients to act as a tax collector on their behalf. They intercept a slice of the payment and funnel it straight to the government.
Moving to Part 2. What exactly is TDS, and why on earth doesn't the government just wait until tax season in July?
Look, in a perfect world, you'd get your full, uncut salary, you'd beautifully budget your tax money into a separate little savings account all year, and then just happily hand it over when you file your return. But let's be real here. Human nature totally gets in the way. Most of us just aren't disciplined enough to save up a massive lump sum for tax season. TDS is an incredibly elegant solution to that very human problem. It stops people from accidentally spending their tax money, it avoids that terrifying massive lump sum burden at the end of the year, and as a nice little bonus for them, it ensures the government gets a steady, consistent stream of revenue all year round.
Okay, Part 3. How the money flows. Let's actually track your salary from your employer to the government.
So here's the exact path your money takes. Step 1. Your employer basically looks into a crystal ball, calculates your estimated annual income, figures out what you'll owe for the whole year, and chops off a 1/12 of that every single month. Step 2. They take that chopped off amount and deposit it straight to the government, usually within just 7 days. Step 3. You finally get the leftovers as your net take-home pay. And Step 4, when you finally file your tax return at the end of the year, you get full credit for all that TDS that was already paid. It's literally just an advance installment payment being made on your behalf.
Which brings us to Part 4. TDS rates and your payslip. Who actually pays how much?
TDS is definitely not a flat rate across the board. For your salary, it's tied directly to your specific income tax slab. But check out the rest of this list. Earning bank interest over $40,000 a year? That's a 10% deduction. Freelancing and crossing the threshold? 10%. Collecting solid rent, like over $50,000 a month? Also 10%. But hey, if you strike it rich in the lottery, no way around it. The tax man takes a flat 30% right off the top. Boom. No deductions, no exemptions.
To really wrap our heads around this, let's take these abstract rules and anchor them to a real-world example. Let's decode Mira's payslip. We'll say Mira has a cost to company, her CTC, of 900,000 rupees per year. All right, so here's her monthly breakdown on paper. Gross monthly salary, a very nice 75,000 rupees. But then the deductions kick in. She's got a Provident Fund deduction of 4,500 rupees, a tiny professional tax of 200 rupees, and yep, right there, the TDS at 5,200 rupees. Notice how her $75,000 gross shrinks down to 65,100 rupees in actual net take-home pay. And a huge chunk of that is because her employer is sending that 5,200 rupees to the government every single month based on her yearly estimate.
Now listen, if you remember literally nothing else from this entire explainer, let it be this. This is the absolute biggest perspective shift you need. Mira has not lost that 5,200 rupees. It has not gone forever. It's actually sitting safely as a prepaid credit in her name with the government. When July rolls around and she files her return, she gets 100% credit for it. Next up, Part 5, Form 26AS. This is your report card for verifying those tax credits. Thankfully, the government doesn't just keep this a secret. They give you a way to track every single rupee of TDS deducted against your name. It's called Form 26AS, and it's basically your master TDS report card. You just go to the income tax portal at incometax.gov.in, log in, hit My Account, and click View Form 26AS. And right there, it shows you every employer, every bank, every client who ever sent tax to the government on your behalf.
Now, why is this absolutely crucial? Well, taking literally 5 minutes to check this ensures your employer actually handed the money over to the government instead of making a clerical error. It makes sure the correct PAN was used, and honestly, you have to match all these credits before you file your tax return. If you don't, you might trigger a super painful and totally preventative tax mismatch notice from the government. Nobody wants that.
Finally, Part 6, Claiming Your Refund. Let's talk about getting your excess tax back.
This is definitely the best part of the mystery. What happens when the government actually collects too much of your money? Yes, you can absolutely get it back. There are a few main reasons your final tax bill might be way lower than what your employer estimated. Like maybe you made some big tax-saving investments during the year, paying health insurance premiums, dumping money into a PPF, which lowers your taxable income. Or maybe you left a job mid-year and had a gap in income, but your employer had already calculated TDS assuming you'd work the full 12 months. Or maybe your total income for the year just fell completely below the taxable exemption limit.
Let's jump back to Mira for a second. Let's say her employer deducted that $5,200 every month, which adds up to $62,400 for the whole year. But because she was smart and actively made tax-saving investments throughout the year, her actual final tax liability drops down to just $38,500. So she's actually paid in way more than she owes.
And this is where the magic happens. Because she filed her return properly and on time, the tax system does the math for her. It takes her prepaid TDS of $62,400, subtracts her real liability of $38,500, and booms, sends a sweet $23,900 refund straight back into her bank account, usually within just a few weeks.
So let's wrap up today's investigation with a few massive takeaways. Remember, TDS is just an advanced tax payment. It is not lost money. Always track your credits using Form 26AS so you know exactly what's yours. File your returns accurately every year to claim those refunds. And here's a pro tip for you. Declare your investments to your employer super early in the financial year. That reduces your monthly TDS right out of the gate, so you take home more of your own money every month instead of waiting a whole year for a refund.
I'll leave you with this one final thought. Check your payslip this month. Log into the tax portal and ask yourself, are you letting the government hold on to money that rightfully belongs to you? Get in there and make sure you aren't leaving your hard-earned cash on the table.